was that one turning point, according to you, that helped you achieve the 20 crores net worth today?
It was about 50% of our overall portfolio was real estate and the other 50% was. The most common mistake that I see is that investors start to invest without understanding their financial goals. And there's this famous quote from Peter Lynch, who is a celebrated fund manager, that more money has been lost by investors in anticipation of a correction than losing in the correction itself. Fixed deposits were not tax efficient. They realized that we need to find an alternative in terms of tax efficient investments. So we decided that debt mutual funds are a good option to go with because...
So can you tell me, for somebody who is in a 9 to 5, what tips can you give them so they can become rich quickly?
Before you start to invest in a financial asset, invest...
Hi Vivek.
Hi Shreya.
I'm so glad that you're here. For the audience, why don't you give a short introduction about yourself?
My name is Vivek and I am from Mumbai, 50-year-old. I have been working in the IT services space for over 24 years. And it was in 2021 that I decided to quit my job and follow my passion for personal finance. While we were investing aggressively, we did not know what our FIRE number was until 2021. Okay, so when we got introduced to this concept of FIRE, and it was gaining a lot of prominence all over the social media, we decided to calculate this FIRE number for ourselves in 2021.
How did you calculate?
Right, so there were different types of FIRE, and we said we want to calculate the fat FIRE number for us.
Can you tell our viewers what is fat FIRE?
Fat FIRE is where you actually inflate your FIRE number so that you could actually even upgrade your lifestyle at a later date if you wanted to.
Yeah.
Okay, and that number has to be 50 times your annual expenses. At that point of time in 2021, our annual expenses were 20 lakhs per annum, which means that we needed 10 crores to say that we had achieved fat FIRE.
Yeah.
Right? But we were pleasantly surprised to know that we had actually already having 15 crores at that point of time, which means we had about 25x of 25 more times more than what we actually needed.
And today your net worth is?
20. Yeah, today it has grown to about, I think 80x because our expenses have also increased from 20 lakhs to 25 lakhs and 20 crores is about 80x of our current
So today
expenses.
your net worth is 20 crores. What was that one turning point, according to you, that helped you achieve this number, the 20 crores net worth today?
Correct. I think our 2 decades plus of investing journey, I think I can call it out in terms of 4 distinct phases. Okay. The first phase was when we started to invest, and this I call as the risk off phase, where we did not have the risk tolerance for equity as an asset class.
Okay.
So all our money that we were saving, all the surpluses that we had, were going into either a real estate or a fixed deposit.
Okay.
Okay. And that continued till about 2014. Okay. And along the way, we were also lucky with one of our real estate investments that gave us 10x returns in those 12 years.
Which year did you invest in this property?
That was in 2002 at one of the suburbs in Mumbai called as Mulund. And we sold in 2014 and it appreciated by about 10x times.
Can you tell me how much you invested and what was the value when you sold it?
We invested 14 lakhs when we bought it and we got about 1.4 crores when we sold it.
Wow.
But what happened was because of the real estate giving us such fabulous returns, all our new money was getting in mostly into real estate. Okay, from 2002 onwards and a little bit into FDs.
Yep. And
over time, we accumulated a lot of real estate in our portfolio.
How much? Like what and all?
So that was about, at that point, it was about 50% of our overall portfolio was real estate and the other 50% was fixed deposits.
Oh, just 2 asset classes? Real estate?
Correct.
FD? Split.
Yeah, and I think beyond the FDs, it was like other investments like, PPF, which again qualified to be fixed income, FD kind of products. So that continued till about 2014. So that was the end of phase 1. I call it as the first phase of our investing. The second phase started where we realized that our real estate investments as a part of the total portfolio was going beyond 50%. And it was getting difficult to even manage real estate. And the other thing was fixed deposits were not tax efficient. So as we were getting into the higher tax brackets, paying more taxes, we realized that we need to find an alternative in terms of tax efficient investments. So we got introduced to debt mutual funds at that point of time. And this was around the time 2015. So we decided that debt mutual funds are a good option to go with, because not only that they had returns similar to the fixed deposits, but they also provided a lot of tax efficient options to invest. So all of our FD money then went into the debt mutual fund. So that was the start of the phase 2 when we got introduced to mutual funds. All our FD money went into, and we stopped investing in real estate.
Okay.
Right. So that was the phase 2 of our
Okay. So
investment
do you mean that you sold your all your properties that you had? One of them was at 14 lakhs that you invested, and it became 1.4.
1.4. We sold it and we reinvested in another property for tax saving.
So now you started investing in debt mutual fund. This was like what? Your salary that was coming in, all the surplus, what you're talking about after expense, whatever was left, that is what you were in. You were investing fresh money. Or did you break your FD and take all the money and put it in?
We did not break the FDs, but whatever FD was maturing, we were actually moving that into debt mutual funds, plus all the surpluses that we were getting through our incomes.
Your real estate was untouched. Yes. That was all.
Yeah. That was giving us passive income.
Correct. So that was all like you didn't touch that. Then you had your FDs, whatever were maturing, you were putting it in debt mutual fund, and whatever other money you were getting from your salary and all, that was all going to debt mutual funds. Okay.
Right. So that continued for about a year or two. Okay. And during that time, we started to transfer the debt mutual fund scheme money into equity mutual funds.
Okay. Right? So you were removing money from debt and transferring it to
equity mutual
fund.
Right. So that was phase 3. I would say that was the turning point for our investments in terms of achieving FIRE. As we got comfortable with equity, we started very slow. It was only a few thousand rupees getting transferred every month initially. Okay. And gradually over the last 7-8 years, and now that we have reached 2024, that allocation has increased from 0% equity to 45% equity.
You said 8 years.
In 8 years, okay. 2016 onwards.
Can you now tell the viewers why is it that equity mutual funds was that, the turning point for you, and it was not debt mutual funds? So kind of give them like a difference of debt and equity.
So debt mutual fund schemes, there are various categories of those, but generally if you look at debt mutual fund schemes, they give you FD-like returns. Okay, so whatever is the prevalent FD rates in the market, you would get similar returns. If your FD gives you, or a debt mutual fund gives you about 8%, okay, and your inflation, lifestyle inflation included, is about 8%, then literally you're not making any money.
Correct.
Right? So basically your capital is not getting, not growing your capital. So that happens only when you actually invest in an asset class like an equity, which gives you at least 3 to 4% higher over the inflation.
Yeah.
And that is what really made a difference to us. So while we started to invest, we saw that growth happening, and over the years we've seen that in the last 8 years that we have invested, the XIRR returns for our equity is 20%. Right? So that really helped us in terms of achieving the number that we have now.
But one would also say that equity mutual fund has higher risk.
It has. But if you know how to manage those risks, if you know which categories to invest in and for how long.
Correct.
If there is awareness and knowledge about mutual funds, I think you can take the calculated risks in investing.
And I feel like when you're investing in equity mutual fund, just know that it's a long-term game.
Yeah, there is a way to do that, and it's a good point that you brought up. I think there's something called as a multi-bucket strategy. Okay, what that means is that your entire retirement corpus actually can be broken down into 4 separate buckets. The first bucket is the bucket that will have mainly the debt mutual funds and arbitrage kind of funds, which are less volatile and more predictable returns. That will have about your 3 years of expenses. Okay, so whatever you need for your next 3 years is in that bucket, which is not volatile. The second bucket is what will have schemes like balanced advantage funds, aggressive hybrids, which will have a combination of debt and equity. So those are again volatile, but not as much as pure equity.
Correct.
Right. Yeah. So that should have about 5 years of your expenses. So once you consume your bucket 1, then you move to bucket 2. And by then your bucket 2 has already got 3 years and more to compound, and also it is less volatile, so you can start to withdraw from that. And when you finish your bucket after 8 years, then you get to your bucket 4 and bucket 3 and bucket 4. Okay, and that can last for your entire retired life.
So Vivek, can you walk me through like what is your asset allocation looking like today? as somebody who's running his business and who's also achieved his FIRE number, like I'm very interested to know like how you have allocated your money today.
Right. So as I can draw you back to that earlier discussion where, at the end of the phase 3 of investing, we've reached to about 45% of our current assets in equity. And that includes mainly mutual fund schemes. And it also includes domestic, foreign equity, and some amount of ESOPs that we had got from our earlier employers. The other 45% is the fixed income asset, which includes debt mutual funds, arbitrage funds. It includes PPF and employee provident fund that we have not withdrawn yet. And finally, the 10%, the remaining 10% is the real estate, gold, and cash that we hold in the bank.
Okay.
The real estate continues to give us, passive income. And the gold investment also gives a bit of return in terms of the fact that it is a sovereign gold bond, which gives some return as well as the tax efficiency is available at the time of maturity. Because as I said, our phase 4 of investing, which is really now when we know that we've achieved our FIRE and all financial goals have been met, so all our new money is now going into equity 100%.
So can you tell me, for somebody who is in a 9 to 5, a young person, what tips can you give them so they can become rich quickly?
So let me give you 3 tips to achieve your FIRE and maybe even exceed beyond that. First of all, before you start to invest in a financial asset, invest in your own skills. When you invest in your own skills, you will be able to increase your incomes. And an increased income means you'll be able to save more, invest more, compound your money more, and achieve your FIRE early. The second thing I would say is budget your expenses. Okay, understand what your needs and wants are. The third thing, which is also important, is the fact that you need to have a process in place. Okay, you need to be a disciplined investor. You need to have the patience for the money to grow and the compounding to happen. All of that will absolutely help you in achieving the FIRE. But I think a bonus tip that I would like to give, which is slightly related but not completely related to it, is about the fact that you should not saddle yourself with buying a property in the first 8 to 10 years of your career, because that is the time you are exploring yourself and looking for opportunities, and you might find opportunities outside your current location. And if you are tied up with a real estate that you have bought, then you take away some freedom from yourself. Also, the fact that you continue to pay an EMI for a longer period of time, and you bogged yourself down to a location.
Got it. Because you mentioned that most of the money that you used to put in real estate and FD was coming through your salary, etc. I think most of our viewers will be very intrigued to know like what exactly has been your career journey that kind of helped you in investing in real estate properties. So can you briefly tell us or walk us through that career journey?
So I'm a Bachelor of Engineering, passed in 95. And then I went over to do a MBA in Information Systems. That was a time when there was Asian crisis. It was not the best time to enter a financial services. The next best option that was available to me was the information technology. And I chose to get into that. And that's where I have been all my 24 years of my career. So I started with a company in Mumbai. My first annual package that I had was 1.6 lakhs. So when I joined Wipro, the salary was 4.5 lakhs per annum.
Okay.
And then in 2002, when I joined Accenture, it was about 7.5 lakhs. And then the last salary that I got from PwC was 65.
65 LPA.
65 LPA.
When did you get this job?
I started with PwC in 2018.
Okay.
And continued till 2021.
So you said before PwC, you were in Accenture. What was your salary there, you said?
When I left Accenture, it was about 50.
50, okay.
Yeah.
Right?
Yeah, it was about 50 to 55. And then that 55 grew to 65 in 3 years.
Okay. So now, Vivek, I feel like there are people who retire and make enough copies for said retirement, right? But I think one of the main challenge they face is they don't know how to spend that money. Like there's no structure. So I want to know, like, have you, like the day you don't rely on your primary source of salary, when that day is not there, how have you planned to spend your corpus that you saved for retirement?
Right. So although we are currently in a comfortable space where we don't have to withdraw from our corpus because of our active incomes, It will be probably a few years, when we start to do that, and we plan to follow the multi-bucket strategy to start withdrawing from that corpus, and we will follow the systematic withdrawal plan process for it as well.
Can you explain to us what a systematic withdrawal plan?
So systematic withdrawal plan is similar to SIP, except for the fact that SIP is when you actually invest money from your bank into your mutual fund scheme. The SWP works in a completely opposite way, in the sense that it pulls out money from your mutual fund scheme and puts it back into your bank account for your retirement expenses.
I have one last question for you. So, what are some of the common financial mistakes you see people make which can be avoided?
Okay, I think because of the profession that I am in, I have the privilege to interact with a lot of investors. And some of those are DIY investors. Okay, the most common mistake that I see is that investors start to invest without understanding their financial goals. That is like starting on a journey without knowing where you want to go.
So you're saying people don't know what they're investing their money for? Like there's no goal in mind.
There's no goal in mind. The other thing is the reason I call it as a mistake is because when you don't know your goal, it is very difficult for you to follow a process, stay on track, be disciplined about it, and be patient. So the other mistakes I've seen with young investors is that they think trading is investing. Okay, and we know the statistics around that. How many traders actually lose money. Okay, so I think the advice I would like to give there is that understand that wealth creation actually is not something that you achieve overnight. Okay, it's a very long, arduous process where you have to put in time. You have to give it enough patience and have the discipline to continue to be invested in. Only then wealth creation and fire are possible.
Yeah.
Okay. Some of the other mistakes that I've seen some of the more sophisticated investors make is that they try to time the market. Okay. So the reason I call this as a mistake is because it is extremely difficult to catch the top end and the bottom end of the market. Okay. And there's this famous quote from Peter Lynch, who is a celebrated fund manager, that more money has been lost by investors in anticipation of a correction than losing in the correction itself. Right. So I think that is a mistake that can be avoided. I think the good thing is that all these mistakes can be avoided if you engage with a good, trusted financial advisor, because they will help, because they carry a huge wealth of learnings from other investors' mistakes, right?
Yeah.
And in investing, like all other walks of life, you need to learn from others' mistakes because you can't make all the mistakes yourself, right?
Correct.
And that's where a experienced financial advisor comes in, because he carries that wealth of learnings that, as I said, can help you in terms of taking the right decisions with your investments.
Yeah, got it. So thank you so much, Vivek. You came all the way to our studio. This was such an insightful episode.